Ladies and gentlemen, good morning. Today I would like to do something slightly different and not start from the fixed income market where very little is going on. I don't think I have anything to add to what I told you last week. But sometimes brevity is better than too much explanation. And sometimes things become so clear in your mind, and if you discuss it with other people and they just think you are crazy, then you know that you are probably onto something very big. I think we are beginning to see the beginnings of a huge change in trend in equities, relative trend and absolute trend, something which is going to shake the financial markets to their core. And yet, the timing is, of course, uncertain, but things are becoming so clear in my head that I need this video to actually share them with you and leave you to come to your own conclusions based on my ideas at the moment. This is a long-term chart going all the way back to 2009 of the spread relationship between emerging markets and SPY, the American market. Nothing new there. We have been banging on about this for months and months and months. Buy emerging markets, sell the United States. And we have absolutely broken the important levels that we had at 0.179 and 0.1763. We are through. We are on in a massive trend. I have drawn some retracement objectives, and the first objective, as you would know, would be, and the most sensible one, would be the 0.382 retracement, and that comes all the way up here close to 25. Well, that is a massive move from here to there. That is a 25% move over the course of the next couple of years. We have to identify how that is possible and see what, not only what the triggers would be, but what the relative movements of the markets need to be to achieve this kind of a target, because it's so massive, it's so unbelievable that when you tell people that this is what you're looking for, they look at you blankly and say you must be mad. Well, clearly we can't be mad, because it's been much higher only 6 years ago. So we're only looking for a retracement, a partial, a very small 0.382 retracement of something that has been going on for a very long time. So let us have a look in more detail at this chart and come to some conclusions. This is the same chart, just zoomed in to have a look at the last couple of years only. It is undeniable that it has broken all the levels to the upside that it needs to break to have a very long run. The moving averages have turned, including the longest, the 200-day, meaning that any moves back will be well supported and are huge buys looking for much higher levels. And it is not just emerging markets. This is ACWI, which is basically the world. So it's developed markets, emerging markets, and everything against the SPY. Same pattern, same break. This is confirmation of EEM. We are headed much higher. We're headed to at least the levels we were trading in 2013, 2014. These charts are both saying, and I could show you some more, saying that there is something deeply unsettling going on in the States, and that the move is going to be massive. It has started, it is in the very early phases. All the charts that we look at are saying, get out of the States, something very bad is about to happen there, and it's not so much a get out of equities altogether, although we think equities as an asset class are going to be sideways and volatile, but it's get out of the United States and go to emerging markets and even developed markets, but not the States. This is a chart of ACWI over SPY just zoomed in, and you can see where it finished the week right on the break line, right on the levels of the highs of 2016, the levels where it was before Trump was elected. And don't forget that all the narrative after Trump was that he was going to make America great again. Well, it looks like he's going to make the world great again relative to America. So what we have here is a confirmation of the emerging markets. We have the trends changing both in the 200-day and the 50-day. The market is going to be absolutely supported on any fallback relative to SPY. This trend is going to be massive and is going to be the trend of the next 2 to 3 years. And before I expand on my argument and show you the possibilities for the equity market individual moves, it's good to remind ourselves of SPY over TLT. SPY over TLT has done a beautiful five wave up. It has done everything it should have done and is now teetering on the brink. If we try to enlarge this chart, if this thing will allow us, we will see that we have a market which is now at the confluence between the 50-day and the 200-day moving average, and right on top of a trend line, or in fact two trend lines. We see that the 50-day moving average is beginning to move down, the 200-day is still moving up. So what it's saying is that we probably need a few more weeks before the market actually starts moving down seriously. So we are in a situation where SPY over TLT, which is one of our favorite indicators for risk on, risk off, is flashing red. We saw last week how XLP, XLY is also flashing red, and we now have a market which is in a highly unstable position in both EM, ACWI, and TLT against SPY. Everything here is saying that these moves will either succeed or they will fail, but in either case, you're going to have a lot of volatility before the waters settle again. Let us compare side by side the charts of SPY and EM. These are weekly charts, both going back to 2012. We can see that actually EM over the course of the past 5 years or so has done absolutely nothing. It has been a range bound, while the S&P has been having a huge run, and that's where the outperformance has come from, and that is why the spread charts look the way they do. So what do we think is going to happen here? Don't forget, these are weekly charts. EM is clearly in a third wave, this being the first wave, and now we are in some sort of a third wave. It is leaving huge gaps all over the place, everywhere. So we're still in a third wave. Well, as we all know, third waves commute into fourth waves, and these gaps get filled. We would not be, this we think is an unsustainable rate of ascent, especially for a weekly chart. We have at these levels a variety of tops We have a top in 12, we have a top in 13, we have a top in 14, we have a failed, attempted it in 15. So we would be surprised if we took out these levels at the first go. It is much more likely to stick around, back and fill, then probably make one more high before it does the usual, i.e. screw everyone who is wrong and fall 20%. What does that imply for SPY? That implies for SPY that if the spread between SPY and EM is going to keep on widening over time, that when SPY does a fourth wave back down and fills all these gaps around 40, the S&Ps will collapse, and they will collapse to the tune of nearly 20%. 20% would take it back to the 200 week moving average, around 2100 to 2200. This level that 2130, which was such an important level, basically where we have been, where we were just before Trump got elected. A lot of people have been talking about that. That would seem to be the obvious target, back down to 2100 to 2200, this kind of area. This would make complete sense to us that it happens when SPY corrects these imbalances and these gaps, and that is going to be a fantastic time to buy EM against SPY. Again, probably not doing it all at the same time, but just buy EM first, and while the SPY gets dragged back up in a probably a B wave, you sell it and you maintain that position, short SPY, long EM for the next few years. This is a forecast chart for EM produced by one of our friends, a technician who we respect, and as you can see, he is forecasting the end of the third wave in the course of the next couple of months, followed by a very brutal fourth wave, which actually comes back even further than 40, and then a fifth wave, which takes it to new highs, probably all the way to nearly 60. So from 40 to 60 would imply a huge move, 38 to 60 even more so. So that is what we are going to be playing for. We're going to be playing for a massive move in relative valuations between emerging markets and the US market. We have been racking our brains about how to know when these moves, these relative moves, will start, and we have come to a very, very simple conclusion. The relative moves will start when VIX closes above 16.08 on a weekly basis. That will be our indicator that we are starting a period of much higher relative volatility, and that we have to hunker down and expect huge spikes, and I am talking about historic size spikes in volatility, probably to at least 50%, at least, because we are talking about a 20% move in SPY in a very short period of time, probably less than a month. We're talking major market disruption, and when that happens, volatility will go to at least these peaks that you see in the weekly charts, which are around the 50% mark. So as soon as we see one close above 1608, we think that that is likely to show us that the moves have started, and that we are not too late in putting on the position even then, although we will put on the position immediately. We could have shown you more charts, we could have gone on and banged on about it, but we think it would have detracted from the clarity and brevity of the message. Bad things are about to happen to the United States. Having said that, let's have a look at. We have looked at all the charts, we've analyzed them, we just haven't shown them to you because we don't think they're that important. We have made no changes in 5, 10 years and bonds and bubbles. There's nothing going on in commodities. At the moment, ES is showing absolutely no signs of coming out of its 3 to 4% range, so we really have no reason to change these parameters at the moment. But still, the danger is to the downside relative to EM and world. XLK is the only market that we still like because fundamentally, not technically, fundamentally, there is nothing like it in the world. You can invest in all kinds of industrials in emerging markets, you can invest in metals, you can invest in just about anything. What you can't do is invest in technology because they don't have any. Will some develop? Well, maybe, but I don't think it's going to be in the next year or two. If you want to own Microsoft or Apple or I don't know, all those other high-tech names, well, you only have them in the States, so you don't have much choice. Russell 2000, basically increasing its trend down by having several closes below 1383. The VIX curve, we still think for the time being, gets steeper before the volatility explodes and then it'll go inverted. The super cycle is absolutely correct. Out of US stocks into cheaper EM and EU. Still a buy on dips against the US market, dollar hedged. Very much in trend EM, very much so. DX, yeah, another weekly close below 93.60. Every time it spoke its head up to 93.60, people come and smack it. It is now likely that the target will be 90 before there is any kind of sustained bounce. And this is what we are adding. The trade for the next year, basically what we are putting on and just leaving there and adding on dips, is the butterfly, long 1 XLK, short twice as much SPY, and long 1 EM to cover it. We will be adding to it in probably 5 to 10 tranches as the market comes down, but the big time to put it on is at the end of the fourth wave in EM, which we showed you earlier. That will be the time when EM will be at its most vulnerable and people will be basically giving up on it, and that will be exactly the time to buy it, and the spread will go massively against SPY. In fact, it's interesting to revisit that. Let us just quickly revisit it so I'm absolutely sure that you've understood what we're saying. When this market, which is EM weekly, finally tops out and comes back down towards 40, the SPY is going to fall down to 2100 to 2200. And while the EM goes to new highs, probably way over 50, close to 60, what is SPY going to do? SPY is probably only going to slowly rise back up towards the 2300, 2400 and make a lower high. So you're talking about a massive relative move which is going to take place when EM comes back down to 40 and SPY is down towards 2100. The best way to play this is via options and volatility, and we will be showing you exactly how on Monday. Thank you very much indeed.